Good morning and welcome to the Saxo Bank Morning Call, our first broadcast of 2019. It is Wednesday, January 2nd, and the new year not getting off in a good mood after that huge bounce into the end of 2018. Peter seems to be led a little bit by these weak Chinese numbers we've seen over the new year, and overnight the Caixin, also the manufacturing PMI. A week, and you've got a chart here of the Shanghai. It's down a lot.
Exactly.
One session.
Yeah, we're down 3% here in the first day of trading in Asia, in Hong Kong. If you look at the chart here, it looks very weak. Technically, it's not exactly screaming strength here. So we are retreating from those intermediate highs we had in the early December, and the numbers just continue to be weak out of China, despite we had okay positive new loans figures back in December. The PMIs, both of the private sector, the Caixin, but also the state-owned enterprises with the more, the official
below
PMI.
50, both of those.
Below 50, and the PMI from the Caixin just continues to tick down month by month. And I think, as Steen gave us this 2019 New Year message, it's all about China this year, and I couldn't agree more. If we don't get this forceful rebound, then and I think we have all the stakes on the table here. And I think I'm increasingly getting a little bit more negative on my own positive view on China from last year, and what we see in the charts and the data coming out of China doesn't rhyme with a strong rebound. And I think actually they have underestimated the consequences of this trade war.
And also deleveraging.
Yeah.
And your perspective for the year, as we indicated, that huge bounce into the last days of December. And despite that, you've got this great chart here of all the Decembers back since 1928. I don't know why you said the second worst December since 1928. Why not just the worst December since the early 1930s? But it was a very bad December despite that massive bounce.
Exactly. I just wanted to be true to the data. This is how far I could go back, and it was the second worst since. But yeah, you're right. It just gives you the magnitude. And I think most importantly, we had this long period since 1987, 88-ish, where we had mostly positive Decembers, and all this talk about seasonality, always a strong year-end rally. And then, ironically, randomness hit the markets forcefully, and we got a 10% down December month. And I think it's quite significant. And you don't get this without some signal. I think there is a signal in this December for the worse. And if you ignore it, I think you're making stupid decisions.
I think it's this whole we're at an inflection point between the post-global financial crisis era into something new. All the combination of a Fed that's not going to be like its predecessors.
Yeah, agree.
And all of these factors, and China and the unknown there. Ola, wrapping up on 2018 as well, we've seen a pretty ugly decline in oil prices, but you've got a great chart here showing all the different classes.
Yeah, it wasn't a pretty end to the year, and as you can see on the chart here, basically we had losses almost across the board. The Bloomberg Commodity Index, which tracks 24 major commodities, was down more than 10%, and you can see no one was really left unscathed. Palladium and cocoa being, nat gas being the few examples to the contrary. And as we can see, we started the year synchronized growth. We ended up on a synchronized sell-off, and it is a trade war, growth concerns, and it's oversupply. But obviously, we're not stopping consuming commodities overnight. So obviously, there will be pockets of opportunities, and obviously, those are the ones we're going to be looking for this year.
But I think the big signal, obviously the most important commodity is oil.
Yeah.
I have a chart here. I mean, this has been a stunning decline here. We do of course have a significant supply situation driving a lot of this downside. Yeah. But is there also some fear on the demand side? Fear.
Absolutely, and that is what has been the main driver throughout the December. That we had the worries about supply from Iran at the beginning of October, and then back then already we had worries about demand, but that was being ignored. Then when the supply didn't become an issue, then suddenly the market started to focus on demand. And as stock markets sold off into December, there was really nowhere to hide, and the volatility we saw over Christmas was pretty crazy. Obviously, there wasn't any liquidity, so that created these big intraday swings. But as you can see on the chart here, technically 50 really is a big psychological and technical level that we touched that over during the Christmas period, bounced off it, and for now, whether we go below 50 or above 57, that's really going to decide the direction.
Okay. And looking forward, I don't have a really good segue here, Peter, but you did have this chart. I think it's worthwhile to consider where we are with valuation after this pretty notable sell-off we indicated. We're getting towards the lower end, or the under, I guess, the average or the Z-score for the long term, but not particularly remarkably cheap in the longer term perspective yet.
No, exactly, and as I said in my December sort of yen remarks, it's a very poor timing tool when you look at valuation, but it's just for the perspective of it. If we sort of continue down here, and let's say, I think it was Rosenberg that mentioned yesterday that if the New York Fed model is right and we have a 40% or 35% probability of a recession next year, and what typically happens is that you both have the price, the price multiple or the valuation multiple go down, but you also have the earnings, which is the denominator in the ratio, go down with it. So you have that multiplication effect on the overall stock market. I'm not as negative as Rosenberg, but I think it's worth having in mind that those dynamics could come into play, and we could go into even further cheaper territory. But if we decline in January, we will have an equity market, global equity market, that is the cheapest it has been since around 2013. And I think at that point, with low interest rates across the board in a lot of fixed income instruments, I think then you should at least have equities maybe bumped up in your portfolio.
Okay, so more allocation to equities once it's getting to those levels of cheapness.
Yeah.
In FX, it's been a very difficult time extracting a signal from other markets. Normally you see FX really participating quite strongly in volatility in other asset classes. That's not really been the case, with very few exceptions, especially emerging markets, largely ignoring a lot of the risk-on, risk-off behavior in December. Very interesting, and I would argue unprecedented in the behavior of the foreign exchange market. Now, one currency that has finally picked up volatility and started to behave relative to its normal historical tendencies is the Japanese yen. Got a chart here of the dollar yen. We see it finally kicking in, the yen safe haven bid. This is a weekly chart giving you an indication of how much we've moved over the last couple of weeks. And we see that that 110 area falling. The 200-day moving average was well above 110. So that's been taken out. The usual Ichimoku levels, the cloud levels taken out on the daily. We're looking at those on the weekly. And I think 110 would be arguably a very significant psychological level for the market to be below. And what are the drivers? Well, the traditional drivers of a stronger yen are both risk-off and lower U.S. long yields. And I have a chart here showing that relationship. It's not always something that fires. I mean, back in 2017, we had this whole convergence story that the dollar was too strong and that the rest of the central banks in the world would start to catch up. And it didn't matter what the actual yield spreads were. Eventually, we were going to head towards Bank of Japan unwinding and other central banks following in the Fed's footsteps. And then 2018 was the year where that proved to be wrong, and we saw the dollar kicking in stronger. But you see that correlation kicking back in now with that very strong sell-off, or not sell-off, but rise in U.S. bonds, lower yields in red, coinciding with the sell-off in dollar yen. And I think that relationship will remain pretty consistent as we look forward here.
And I think that leads us very nicely into the next one, because lower yields and a stronger yen, both very gold friendly.
Yeah, exactly.
And we actually had the best quarter for gold since since Q1 2017, I believe it was. So we have a chart here just to give you an idea about the accumulations. As you can see, this is ETF holdings. ETF holdings ETFs tend to be bought by investors who have a slightly longer term view than those trading the futures market. And this really has been quite a strong accumulation we've seen so far. And as I mentioned, with lower yields, with a stronger yen, with the growth worries, with the stock market uncertainty that Peter's mentioned, these are themes that gold investors
they're
like.
fearing the next round of policy response, which is to make sure that we have maximum money printing, maximum low real yields.
Yeah.
And that's tends to be a gold positive. You got a chart here. Any levels you want to point out on the gold chart?
Yeah, because the question is really then what happens? Where do we go next? And we have really reached now the key level. Just like oil on the downside has corrected 61.8, gold has now also corrected 61.8% to the upside of the latest major move. So 1287. If we make it above there, then we're likely to see a 1300 handle fairly soon. And support wise, we really need to hold the 1262 level. I just have to mention that the cut reports from the CFTC due to the government shutdown has been delayed, so we do not have any data covering the pre-Christmas period, and we're probably unlikely to see the data for this week either. So there's going to be some uncertainty as to how investors have been reacting to these moves.
Yeah, and my understanding is on the data, and we'll go to our calendar here. If we look at, if I can get the chart up, let's see. My understanding is that they are funded for the employment data through September. I don't know if there's going to be a delay. Apparently there was a delay the last time around with the shutdown, but my understanding is they are funded for that. So we should be seeing that on Friday. I assume the ISMs are not affected by that, but of course stay tuned on the news to whether and which data are delayed. But today we have various PMIs, but not the ISM, which for some reason is not until tomorrow for the U.S. And then that end of the week employment data. I'm not sure how reactive the market is to data. We've pretty much taken out all of 2019 expectations from the Fed for 2019. So pricing in, I would argue, pricing in easing is getting a bit over aggressive at this point. Do keep in mind on the political front, the new Congress is sitting as of tomorrow. And this is going to be a politically interesting year with this Democratic House in charge. And what do we face in terms of the Mueller investigation, attempts to at least take down Trump politically, perhaps impeach him. And then we have Powell out in an interview on Friday. And also up for this month, we have at the end of the month the FOMC, but we have to get some answers on Brexit, as Euro sterling, our barometer for sterling, is just totally in indecisive area here at 0.90, awaiting for whether we're headed towards a second referendum, a delay, a hard Brexit. I would argue a second referendum delay is beginning to be more likely here, but we'll keep on top of that as well. That's it for us today. We'll be back tomorrow with the Saxo Bank Morning Call.